I think that the community banks have gotten squeezed over the last several years. I mean, that's just the harsh, cold reality of it, that they've gotten squeezed by the larger banks with certain types of businesses that benefit from economies of scale, such as credit cards, mortgages with the originate-to-distribute model. I think on the other side, they've gotten squeezed by the non-bank providers, so payday lenders and title lenders and folks like that. I think have siphoned off a lot of the more traditional mainstream lending that was done in local communities, and I think that's unfortunate because I think those are very high-cost providers, and they need more regulation, and they need better rules, and they need some enforcement. But there are some institutions that are under stress right now, and for them it's a very difficult environment, and so we have really encouraged our examiners to take a balanced approach in how they examine and deal with community banks who are having some challenges, and most of that's coming from commercial real estate losses. And so we've tried to take a balanced approach and not overreact, and try to help banks and provide guidance that are having some troubles and maintain their capacity to do prudent lending. And that is the consistent message we have sent to our examiners and will continue to do so.
The difficulty of competing with these too big to fail institutions is a real concern for our members. If a depositor wants to put money in a bank and knows that one of these large institutions is going to be bailed out if it fails, well, you know where that depositor is going to put the money. Money is going to be put into the large bank and not into the community bank. And there lies the competitive problem that community banks have throughout the country. I think if anyone had listened to that hearing last Friday before the House Financial Services Committee, it was a joint hearing with the House Financial Services Committee and the Small Business Committee, you would have come away with a conclusion that the regulatory environment that community banks are experiencing right now is unprecedented and is in fact the reason why, or chief reason, why we have a problem with small business lending in this country and why the economy is not pulling out as fast as it should be. I think it will be a tough year this year, but I think next year we will see ourselves pulling out of it. I'm optimistic, and our economist is saying that is concluding that yes, the CRE problem will remain throughout this year, a little bit into next year, and then we'll see ourselves pull out of it.
One of the first questions I started asking myself in this, I guess, arena of the meltdown over the last 18 months was, did our consumer laws fail? And Chairman Bear alluded that, you know, maybe we do need to relook at all of our consumer laws, and I agree with that. But it's not the laws that I have to deal with on a daily basis. And the reason I say that is having come through the 1980s in Oklahoma when we had our own regional meltdown, a lot of us learned how to loan money the right way then, and we never stopped. And that's why Oklahoma probably has fared better than the rest of the nation as far as our unemployment and what's going on. Bankers should have been aware that there are people that will come in seeking advice, and you know, we should have, if we were the ones making the mortgage loans, we should have counseled them on could they make their payments. And that's where this whole country and all of us fell down and failed to help the consumer. 50% of the mortgage problems were originated by people outside of commercial banks. So in this recovery of our country, consumers always lead us out of the recession. And yet, right at this point, I think what we have is we have banks unwilling because they're scared, and regulators that are being heavy-handed.